welcome to the Daily Energy Markets podcast. It is June 12th, and we have Brent crude oil trading now back in its happy place. It's 2024 happy place in the low 80s, 82. 30, a little bit up, but that gradual recovery after the big sell-off last week, after the OPEC Plus meeting, bit of turbulence in the market, not quite sure how to digest all the announcements by OPEC Plus on the 2nd of June. There's got a lot of bearish sentiment on the back of that, but has been in recovery mode this week and driven at least on today's sort of outlook. Reuters are pointing towards the renewed commitment on demand growth, incremental oil demand growth for 2024. OPEC Plus issued its monthly report yesterday, still sticking to that 2.2 million barrels a day. And meanwhile, the EIA, the Energy Information Agency in the United States, raised its demand growth forecast slightly, but only to half of that. So the EIA and the IEA together are sitting on a incremental demand growth of 1.1 million barrels a day, and OPEC is still sticking to its 2 million barrels a day. So that's quite a difference, but nonetheless, the market is lifting. And my question this morning to Bora Bariman, managing partner at Hormuz Straits Partnership, sitting in London. Bora, which is the market betting in when it sits in its happy place of 82, low 80s for Brent crude oil? What demand forecast is the market betting in at that price level? Is it the EIA one at 1.1, or is it the bullish bumper 2.2 at OPEC?
I think that's a very difficult question, right? It's a finely balanced question because both data sets are in the market, and the market is digesting that and is coming up with the price based on all the available information. But it seems to me that the outlook is that the U.S. has a pretty kind of stable and growing demand, and this is reflected in the jobs report, which is going to be reflected in the steady as you go rate decision from the Fed, as per my expectation, later this afternoon, and also as reflected by the fact that Europe is bringing rates down and accepting higher inflation, and trying to do something about its high cost of energy, due to the fact that they're not accessing Russia per the new paradigm, which we're never going back to the old paradigm of accessing Russia normally. So these are what I'm trying to say is these are kind of stimulative factors that perhaps have caused the market to drag the price of crude back up.
Bill Spindle, senior global correspondent at Cipher News. Bill, opportune that we have you on this morning. Of course, you're one of the leading journalists covering the energy transition and all things tackling climate change. So I wanted to get your immediate reaction to the decimation, you'd have to say, of the Greens, the Green agenda in the European election results that are trickling in over the last 24 hours. In Germany, the Green vote has been halved. In France, similar, maybe some small gains in smaller Nordic countries, but nonetheless, a really bad election for the Greens. How do you interpret that? What do you think it means?
Yeah, I think it's, obviously we're getting into the teeth of the energy transition, and you're going to see the realities start to bite in some ways, and I think you're starting to see that really around the world. Here in New York, we saw a congestion pricing plan put back on hold. Probably looking forward to the election here. Similar dynamics in Europe. You're seeing a lot of pauses, but I still think we're looking at really a pause here as we work through. Obviously, the big question suddenly that President Macron has given us is, what are the realities of this going to turn out to be? In the heart of Europe, when offered a chance to really put some of these right-wing parties in real power. So I think that'll make a big difference. Again, I think it's more a pause and a reprocessing as we get into the heart of this energy transition. But it's really, I think, unstoppable. It's really a matter of pacing and how it progresses from here.
James McCallum, CEO and Chairman, Exergy Group, Professor of Energy, Strathclyde University. James, as you sit in that sort of nexus between those two worlds, obviously you're one of the world's leading drillers, but you're also now a strong advocate of the energy transition, and you're a European. So how does this all stack up to you, and particularly from an industry point of view?
Yeah, look, I mean, both the commentators have made extremely valid points and very much on the money. Although, I'm not entirely sure Bora's assertion of it's steady as she goes is broadly correct. I think Bill is closer to the mark with a reassessment positioning here. Look, I think that what we're witnessing is a degree of realism in terms of the energy transition. And whilst there's a lot being made of the move to the right, perhaps a little bit too much being made of that it's to the far right, it's certainly a little bit of a nudge away from centrist right in Europe. The reality is that the votes, as far as I see them, are votes where people are saying, look, we want leaders who make decisions. We want, and we don't want it all to put everything on, well, for want of a better expression, on green. We recognize that energy prices are too high, especially in Europe, the point that Bora made. And we want those energy prices to come down. And that's what people are voting about. Clearly the European elections are about pricing and about immigration, and that's what it's about. But as Bill said, President Macron has played a really big, well, be careful what you wish for card here. And I think we will see that play out very interestingly over the course of the next month. For me, I think this is a sort of we're still in a world of wait and see politics, certainly in Europe, as to what will happen over the course of the summer. The price that you talk about, whether it's the IEA forecast or it's the OPEC forecast, is still very much in a wait and see place, and there's nothing big nudging it either way. The speakers earlier in the week, though, I think have been very, very good, Sean, in as much as that whilst Omar, who is, if you like, a eternal bull in this particular space, does acknowledge that sentiment on the commodity traders is predominantly bearish. And if you take a look at the non-OPEC producers, the super majors, and see what's actually been happening in their share price movements over the course of the last 1 to 3 months, it's downwards. The service companies, it's downwards. And that simply tells you that, there is not a view that the international super major producers are going to change anything fast, and therefore activity levels are going to be stymied for the foreseeable future.
Just to pick up on that, James, I mean, the connection then between the European election results, as you say, the move to the right of the right of center, the sort of very poor performance on the Greens in terms of the European Parliament. What do you think the majors are going to take from that? They've already got out in front of that by backing away from earlier commitments to the transition, i.e. the European majors. The Americans never really got on board. But does this justify their move? Do you think they'll move even further? How do you think it lands with the majors?
Yeah, look, I think what's been played out and doesn't get discussed enough is that it's the investors that are driving what the super majors are doing. When you take a look at, what was happening in Europe with BP and Shell and Equinor versus what was happening in the United States, with ExxonMobil and Chevron, clearly there was a demonstrable difference in the share valuations of the European super majors to the US super majors. And the European investors and the US investors in the European super majors were saying, that's not acceptable. I invested in you as an oil and gas producer. I expect you to be an oil and gas producer, and I expect to get the same level of share price performance and dividend performance that I would get if I was investing in your counterparts in the US. And the investors left the European super majors no choice but to swing away from that energy transition debate. Now, on a personal note, I think that's deeply disappointing. I come back to this leadership point, which Bill, I think, was touching on. I'd be interested to get Bill's views on this. We had just begun to swing back to a place where the energy companies were again, perhaps adopting an image that was, yeah, okay, you are a bit enlightened here. You do see the big energy landscape, and you are prepared to take a position on that across the perspective. Instead, they've gone into reverse gear, as you quite rightly point out, Sean, and I'm afraid that's leaving the industry exposed and very much exposed in terms of the talent that it needs to do anything going forward. If you simply jump from the energy sector into the academic sector and look at the number of universities that have pulled away from petroleum engineering degrees, science degrees like geology, geoscience, reservoir engineering, all of the skill sets that are needed to take up the activities of long-term hydrocarbon development, they're killing those courses. The students aren't coming into the courses to fill the gaps that the old guys like myself are leaving. So it is a very, very difficult time for the energy sector, and the ability of the big oil companies to do anything different than their core business is proving extraordinarily difficult.
Bora, your earlier comment, I mean, I'm thinking of what's given the market some floorboards this week. Obviously, these demand outlooks looking, a little, are bedding in, and they've been there a while. But the what's changed this week has been the start of the easing cycle, ECB most notably, but earlier in the week, Canada. Fed to meet today, not expected to change strategy at this point, as you noted, but will give signals. Your thoughts, do their signals change on the back of ECB and Canada starting the easing cycle, and what the second half looks like for monetary policy and hence its support on this oil market?
Look, I think the signals, just my view is that they're not changing, but there are mixed signals, and I certainly didn't mean to say that everything is hunky-dory and stable when I gave my opening remark. But my theme is that the Fed gives guidance and reserves the right not to follow that guidance, as we've seen throughout this year. We're supposed to have 4 rate hikes, 5 rate reductions. We've had no movement. And whatever the Fed says about keeping things steady, as I expect they will say later this afternoon, who knows? Toward the end of the year, we may see something completely different, because there isn't a consistent narrative based on the data. The countries are being pulled in different directions. America's going one way, Europe's going one way. Here in the UK, we had salaries and bonuses rise 5.9% year on year, double the inflation rate. So it's not likely that the Bank of England will take an interest rate cut decision given that data. But there may be something else that gives in the situation. People are not feeling this bump, right? That their salaries are rising at twice the rate of inflation, that things are hunky-dory based on that data. That's not the feeling here in the UK, and certainly the government is not going to benefit from any such feeling. But there is a logic to their decision to take the elections forward. If people aren't feeling positive now, how are they going to feel later? So better now than later, and maybe that's the uh, calculation of Macron as well. You know, hearing what James said about the energy transition, and the impact on cost of living. France has baked it up pretty well when you look at it from the big picture. They've got a nuclear program, they've got a renewables program. They're not dependent on Russian gas, and their industry is not suffering like Germany's. But nevertheless, people do not feel confident, and there is this volatility bubbling in the political level, on the economic level, geostrategic level, that we'll have to live with. So I'm not making
Well, it certainly will
strong
be
predictions.
interesting. It'll be certainly interesting to see if what we're seeing in France in the last 24 hours, the noise around the merger between the center right and the far right into a single bloc for this election. That would be quite dramatic for all of Europe.
I think it's happening.
Yeah, well, I think there's some backlash within the center right. We'll see. There's still something to play out there. But Bill, if you're Joe Biden sitting in the White House, Donald Trump sitting in whatever house, and looking at Europe and looking at these election results, I mean, I like the phrase you used earlier. We're in the teeth of the energy transition, and these are the vibrations that come with an inevitable outcome, which is a transition. But how do you play this in the US election? How do you think this resonates in America, which has been a reluctant transition, and Biden has been an advocate, not necessarily a dedicated one?
Yeah, I think that's where we're all eyes are now, I think, going to start really turning towards this U.S. election, because that's really the turning point in all of this stuff we're talking about. The direction's really going to be set in many ways by who wins this election in the fall, and it's too early to sort of, I think, tell which way that's going to break. Despite all the noise going on now on both the economic and the political front. So we're going to have to wait till after Memorial Day here in the US. That's early September, or Labor Day, I mean, early September. And then people start looking towards the election. And I suspect sometime in October, late September, October, you're going to see voting, these undecided voters, very small number of them, but very significant, are going to start to break in these states, and we'll start to see which direction we're going to head. And that will, I think that will have a big, who wins the election.
The green energy piece, Bill, in like in Europe, which is sort of in the same bucket as inflation pain. When those two are consolidated into the same message, that's a lose vote. And I wonder,
and may turn out to be in the U.S. too. And may turn out to be in the U.S. too. It's possible that is the direction we'll head in. I think it's important to remember that the oil and gas sector is not the sum total of the energy transition. So, in some ways we're debating about whether they're going to lead or follow in this transition, not whether there's going to be a transition or not. And obviously whether they lead or follow, will have some impact on how fast it goes, but it's not going to impact whether it goes. Really, it's really a matter of whether they're going to get out in front of this and transform their industries, or as is a perfectly reasonable option in the non-national oil company world, is simply ride out, take your profits, and then wind down when the time comes, which will obviously be some considerable time in the future. So I think we're going to
leave it to the government, because if I'm ExxonMobil, it's not my job to manage the climate, I suppose, is kind of the posture. But this immediate sense, I suppose, the momentum out of these elections in Europe, I think people were expecting the move to the right, but they were expecting it to the far right to come from the center. The payers would be the center and the center right, but it's turned out it seems the center is held. It's the left that's got crushed. The Greens.
Yeah. Well, I think, again, you've got this question of how real do voters want this to be? And again, you're going to see that same question come up in the US. Do you really want Trump back? Is that really the government you want really running the show? And that's a question I think is
Well, it's
quite
certainly I think the election in France, James, is going to be a good guidance to that. Whether when presented with this sort of in your face choice. I mean, it's one thing to throw a vote at a European election that for most Europeans can still feel kind of remote, but actually when you bring it home onto the national stage, will the people still press the same button?
Yeah, look, I mean, I think for me, Bora made a very good point around the energy balance that sits in France. I think for me, what's going on in France is far more around immigration than it is around energy policy. If I go to obviously my homeland where Bora is sitting right now, we've also got a UK election coming up in the next few weeks, and certainly it is not anticipated at the present moment in time that we'll see a move to the right in the UK. It's exactly the opposite. The expectation is that we'll see a very, very significant move to the left. So people want change. What's going on here is a great deal of protest votes off the back of the years that we've come out. And the point which Bora makes, which is that people do not feel affluent, they do not feel confident. And if I can just pick up on something that Bill said around the transition, so much of this right now is around, where confidence comes from in terms of the energy transition. And if I stick for a second in terms of financial confidence, that's what's causing an awful lot of the difficulty here. We've seen some very large renewable energy projects, fail to meet their final economic hurdles in the United States. The same thing flowing back and into Europe. We're seeing a very, very fractured supply chain. What roles in terms of equipment supply into that renewable transition story does the US want to play? Will Europe play? Will China dominate in? So it's a very fractured landscape. And at the present moment in time, there's no clear pathway forward. For the big oil and gas companies who are moving, they themselves have had to struggle with two very, very different economic models in terms of where they invest their capital. And as I said earlier, that's caused their shareholders to simply say, right, enough's enough. If I want to invest in renewables, I'll invest in renewables when the landscape is clear. You stick to your knitting. I give you my money to go and develop and produce hydrocarbons. So it's a very different picture depending on whether you look at the US, whether you look at France, whether you look at the UK, and there's an awful lot of protest voting going on, Sean.
Let's go to the survey question, which is sort of the theme of what I was mentioning earlier. Which 2024 oil demand growth forecasts are markets betting in with Brent crude oil averaging the low 80s? And I don't buy Bora's answer, which is, they're betting in all of them, because these are not 1.1 versus 1.2 versus 1. These are 1.1 versus 2. This is 1 million barrels a day difference. That's 365 million barrels over 12 months, over 52 weeks. So, this is a huge difference. And if whoever's right or wrong here, that could result in fairly significant swings in the market in the second half. So that's my question to you. Choice. Now, I didn't give you Bora's number 3, all of the above. So it's 1 or 2, and I think we'll take the view and see where that goes. But Bora, what I do want to get your view on is we're back at the sweet spot, the happy place, as I say, for 2024 Brent crude oil prices, sort of the exact average for the year to date, just knocking on the door of 83. 10 days after the OPEC meeting, Bora, and all the turbulence last week, should we assume that the OPEC decisions, which were quite significant and many, the market has kind of digested now and said, nothing's much changed?
Look, I think the OPEC decision was very. This is the feedback that I'm getting from basically this forum, is that they've been so transparent. Where they stand. What we don't know is where the demand side stands. And I'm gonna change my opening remark and say they're looking at the gloomy side, the IEA side, basically. And I say that in the context of Omar chirping along on my ear and saying, look, if it was at the OPEC forecast, we'd blow through the roof. We'd blow through the roof. So it is what it is. The demand is where it is, and the supply is where it is. And this is the price you get, $82. Imagine that it was stronger. Where would it be? So that's my revised answer.
Well, you got there in the end, 30 minutes later. Bill Spindle, there's no better man I'd want on today to tell me what has happened in India. I mean, all of this stuff we're talking about in Europe and wherever its relevance whatsoever. Biggest shock of the year to date, election-wise, has to be Narendra Modi not getting a majority. You were the Wall Street Journal correspondent in India and Asia for many, many years. Your thoughts on that result and what it means for the juggernaut that is the Indian economic story?
Yeah, a bit of a surprise for the BJP to come in not nearly as well as they had advertised, hoped, and expected. I don't think it will change a ton in broad policy because their coalition still runs the show completely, and they pretty soundly run that coalition. But it will, I think it will temper some of the real aggressive, particularly Hindu nationalist policies they'd like to pursue. And in that sense, I think it probably is a good thing for the economy. Because you'll really, I think they'll focus on practical things. They'll focus on improving the economy without getting sort of sidetracked into a lot of the broader kind of social goals that the BJP shares with its larger, Hindu nationalist constituency. So I think
there was a lot of talk with the supermajority that was kind of predicted that he would be able to privatize a lot of those big state energy companies, the 4 or 5 of them. Narendra Taneja, our sort of standard Indian Bear energy analyst, saying yesterday that that's very unlikely now, at the most one.
Yeah, I think that's probably true. And that's not the margins at which I think you're going to see some slowdown. But I think the benefit that comes from some of that is you'll see a little bit less turmoil and hand wringing over the social stability and all those things. And again, I think it's more of a slowing down as they move in that basic direction, rather than a sort of plunging forward, because all of those economic changes that many people are hoping for, come along with a strong BJP majority that would also be pursuing very aggressively some of these larger social things, which I think do cause the sort of turmoil that ultimately could be a huge setback for India.
James, last word for you. I mean, one of the things that has been, I think, keeping the oil price a little bit under control this year so far was the expectation of new oil supply coming from the non-OPEC universe, non-OPEC plus universe, and particularly the Americas, which were the big story last year. But that's not happened. And I think the penny's starting to drop that actually U.S. oil production this year will probably be pretty flat, if not even slightly down on last year. We've got the EIA saying 13.3 or something like that. So ultimately no change in U.S. oil production. At $80 average, what's going on? Surely that's a price you'd put money in the ground in the U.S.
Yeah, well, there's 2 factors to it. Obviously, there's the price at $80. As we all know, the Permian and the Eagle Ford formations, these are quick in, quick out. So where the oil companies do want to raise activity, they can do so relatively quickly. But there is a second factor at play, and that is the cost of capital and access to capital. And that's another dimension of the energy transition story, which we didn't get into discussing today, which is that it has become increasingly difficult for oil and gas hydrocarbons companies to attract investment capital, whether that's debt finance or indeed equity finance over and above what they already have. So the reality is that the United States is predicting pretty much a flat production forecast. Now, full credit, Sean, that 13.2, 13.3, 13.5 million barrels of oil a day, that's an incredibly impressive statistic. But the investors aren't buying anything bigger. And you can see that, as I said when I started, in terms of taking a look at the oil company share prices, taking a look at perhaps an even better indicator, the rig supplier share prices, the equipment supplier share prices, and they are all down and they're on a steady decrease over the course of the last 3 to 4 months. So that, if you like, hopeful rise in activity in the non-OPEC space isn't being seen by investors, isn't being forecast by investors. And that's, I suspect, why the vast majority of the commodity traders are bearish.
Just to follow on from that, James, so this, as Bora told us, it's number 2. But James, the momentum of growth out of the US production coming out of COVID, particularly last year, was driven a lot by wells that were already completed but not active.
Correct.
And so we've
recompleted.
Recompleted, that's the word.
Yep.
And they basically worked their way through all of that inventory, and all those wells are already dug, are now active, but to go further, you're going to have to put a lot of money in the ground to put new wells. Is that more or less
a lot of expensive money in the ground, a lot of new equipment which the service companies have not invested in, a lot of rigs which have been stacked for a long time, down from 1,800 at the peak in 2014 down to roughly 17. They're down to 700 now. So a lot of old equipment, a lot of non-new inventory in terms of downhole equipment, and a lot of expensive capital. Not likely to happen.
Yeah. Well, we had a round table yesterday with energy traders in Dubai, and pretty much to the man, there wasn't much appetite to short this market. They saw that the big short that's on at the moment, that wall will break as this incremental oil price, Brent, goes back closer to 85. And when it breaks, there could be a big rush up, because without US production growth and with GDP generally growing around the world, nothing spectacular, the view was that we'll go higher from here. Not a surge, but ultimately higher, and that short will break, that short wall. James McCallum, rock star, thank you so much. Really great to have you. Bora Barryman, that's really awesome. London, get out there and vote. And lots to choose from, I would say. Lots of colorful characters there now. And Bill Spindle, as always. Bill, great to have you. Where are you at, Bill? Are you in New York now? Where are you? You're always around the world. You're in Boston. Okay. Well, the other Irish town. All right, guys. Thank you so much. Catch up with you all
Thank you,
again.
I'll see you again.
Bora,
Bye-bye.
nice to see you guys. Bye-bye.